For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
You have suffered financial loss while investing, and you think your bank, broker, fund management company, unit trust management company, PRS provider or distributor, or their agent or representative is responsible. You need help sorting out the problem or want to seek redress. Where do you go? Sidrek is here to help you start the conversation and reach some resolution. First, lodge a formal complaint with a company that sold or offered you the unit trusts, shares, derivatives, or other capital market product or service. But you're not happy with their response. You have 180 days from their final written reply to come to Sidrek. Or if there's no written response, and it's been 90 days since you wrote to them, you don't need to wait longer. You may come to Sidrek even though you haven't received a final response yet. Sidrek first checks the eligibility of your claim. For example, is it within Sidrek's claim limit? Is it against a member of Sidrek? And so forth. If your case is eligible, we begin the dispute resolution process. All information in this process is confidential. We get both you and the member you're complaining against to sit with us and have a conversation. Documents and information will be required from both parties. No lawyers are allowed in the mediation process, as we keep the discussions informal and private. Our mediators are impartial and will hear both sides out and help parties communicate constructively towards resolving the dispute. 2 outcomes are possible at this stage. Either both you and the member agree to a settlement, or you don't. If the both of you agree to a settlement, an agreement is signed and the mediation process ends successfully. But if both you and the member fail to reach a satisfactory resolution, mediation has thus failed. But don't worry, Sidrek then proceeds to the next stage, adjudication. During adjudication, parties are given the chance to provide any further information to help their case and ask each other further questions. Our adjudicator will then study and consider all facts and information provided, including the conduct of the parties, laws, and best industry practices, as well as what's fair and reasonable. Sidrek's adjudicator will then make a final decision on the dispute and the monetary claim. If the decision is in your favor, it could be a full award or a partial award for your claim. But if the decision isn't in your favor, then no award will be made. You, the investor, will still have a choice. If you reject the decision, Sidrek will simply close the case and you may seek other legal avenues for redress. If you choose to accept the decision, however, the member has to comply with it. Once the parties have confirmed compliance to the decision, Sidrek will close the case. So let Sidrek help start the conversation towards resolution. For more information, visit sidrek.com.my or call 03 2282 2280.
Bursa Malaysia has been part of the Malaysian economic growth for over 4 decades. We have been working relentlessly to create a transparent, efficient, and vibrant stock exchange.
While we've been working at building a vibrant marketplace, inclusivity and contributing towards economic growth, we have also channeled efforts and resources towards supporting the community at large. Shares to Share is one such effort, which has been developed to create positive impact towards society and the environment. To put it simply, Shares to Share is a transparent and easily accessible facility that enables investors to donate their listed securities or proceeds from the sale of their listed securities towards charity through Yayasan Bursa Malaysia. You can donate odd lots or even board lots. The funds from the sale of these shares will be channeled to approved charitable organisations and their respective initiatives or projects.
Bursa Malaysia has waived its portion of the transfer fee, clearing and trading fees for all transactions that are conducted under Shares to Share. The participating brokers of Shares to Share have also agreed to waive their portion of the transfer fee and brokerage. The charitable organizations that have been selected have undergone the necessary due diligence process and have been duly approved by an independent selection committee.
At least 500,000 populations live with some kind of disability. They are most of the time being left behind. We need to empower them, otherwise they will continue to be the liability. A lot of human resources wasted from this group of people.
We provide a lot of support for persons with disability who are young adults and adults. We have a social enterprise called Project I'm Possible, where we manage to hire all persons with learning disability to work here. We have a cafe, bakery, weaving, and we have an art gallery.
Purity of thought, word, and deed, that is action, is very important to be really successful. We must know some skills to be able to help us then paperwork. The grant from Shares to Share will be used for, one is sewing, handicraft, classical dance, and so on.
Our patients have to be fed, they have to be looked after. We look out for any sort of disease they might develop, and also those unforeseen circumstances. Thanks to Bursa's initiative, we can be a little bit easy on our patients if they are family members.
Donations will all be channeled to organizations that are involved in the sustainable development of Malaysia. The Shares to Share scheme offers you the chance to do so in a simple and effective way.
Bursa's Shares to Share allows us to do good by donating our shares to charities. Join us in making a difference to the society by donating your listed shares.
Shares to Share is open to all donors, individual as well as corporates or other types of entities. You can transfer your listed securities via Bursa Anywhere app at a click. For more information, please visit our Bursa Malaysia website.
Hello everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today our webinar title is Don't Fall into the Value Traps in Value Investing. So how is everybody doing? This is Shen Chu. I'm the moderator for this webinar. Now, have you ever encountered a situation where you bought a share thinking that it is undervalued, only to realize that the shares remain undervalued or remain cheap for a prolonged period of time? This could probably be value traps. So value traps happens when we think that you get a bargain, but in fact, we actually got trapped in the area of value investing. So today, we're going to examine what are value traps and how to avoid falling into these traps. So before we begin, disclaimer, whatever you share in this webinar is only for educational purpose In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you are 100% responsible for all your investment risk. Allow me to introduce our speaker today. He graduated with a bachelor degree in finance from Coventry University, UK. He is a licensed financial planner. He is also a financial advisor's representative. He's the co-founder of EE Cameron, with sharing contents of more than 1 million views. He has more than 9 years of investment experience, and he has also trained more than 1,200 working adults to master the wealth growth strategy in 3 years, in which he formulated. So he's none other than Mr. George Poh. George, how are you doing?
Hi, Shane. I'm doing very good today.
Yeah, fantastic. So we can't wait to hear from you. How do we avoid value traps in value investing? So let me just hand over the session to you.
Okay, thank you, Shane. All right, let me share screen. Good evening, everyone. All right. Can everyone see my screen now?
Yes, perfect.
Okay, great. Thank you, Shane. Now, good evening, everyone. So I hope today's you are already prepared, to learn about how we can avoid the value traps. Okay, so the disclaimer and also the profiles I skip. All right. So what we will learn today, right, out of this webinar. First, I will teach you how to identify the value traps using the fundamental analysis. Now, I believe most of you already know what is fundamental analysis, but don't worry. Later during my sessions, I will also come step by step with you, to revise, some of the ratios and some of the financial indicators that we use in fundamental analysis, just to identify the value traps that might happen when you are doing value investing, right? And then second thing, I also would let you learn the methods to avoid the traps, because once we identify the traps, then we know how do we identify it and what are the symptoms, when there is value traps. So by knowing that, we can avoid the traps and avoid losing big money. And thirdly, if you are already in the value traps, which you might not know at this moment, but after the sharing later, maybe you will think that, hey, I might be in the value traps already. What can you do? All right, I will let you know how can you do. And lastly, I will show you a real case studies in Malaysia that happened, just to demonstrate what is the value trap in the stock market. Now, are you ready? All right, are you ready? Okay, if you are ready, let's work on it. All right. So whenever we talk about value traps, there's always one thing that come into our mind. People will talk about this false accounts, right? When we talk about value investing, all the things that we mainly look at is the financial statements, right? It's the annual report. It's the fundamental of the company. Now, how do we qualify or quantify a company's, their values? Is by the numbers, it's by the accounts, right? So whenever there is a value traps, the most obvious place that it will happen is in the accounts, right? So this word you need to know is called false accounts. Now, what is meant by false accounts? It means that the account does not truly reflect the company's transactions or events. That means some of the transactions are wrongly keyed in the accounts, or they purposely put it in just to let you see that the accounts are doing very good, So these are what we call the false accounts. Now, secondly, the false account does not truly reflect the company's productions and their management activities. Now, when we say it does not reflect, right, it means that if, let's say, the company is doing worse, the company is doing very badly because of the economy, because of the company's productions kind of thing, right? But in their accounts, they saw that, oh, our company is growing. Our accounts, you can see our revenue is folding, So when they show you this kind of thing, right, it is not truly reflected in their productions, in the accounts. So these are what we call the false account. And thirdly, this account does not handle the business in accordance to the accounting standards. Now, I might ask a silly question here. How many of you here are an accountant or an auditor? All right. Then you might know that there is accounting standards that all the listed companies or all the companies have to follow, right? So in Malaysia, we follow some accounting standards, you know. In America, maybe they follow their own accounting standards. So different jurisdictions, they follow their own accounting standards. Now, so when we study a company, we also need to know what accounting standards that they are following. Because different accounting standards, right? Some of the items and some of the numbers or the figures, they have to key in according to the standards. Now, you cannot simply say that, okay, I love to put this $1 million into my revenue. Then you can just simply plug in. You cannot, right? Or you say, okay, these receivables, I wanted to put it into my let's say it's a trade receivables, right? They say, okay, I want to put it into my long-term assets or my, you know, non-current assets. Can we do that, right? So it all falls under the accounting standards. Now, false account might happen when they do not follow the accounting standards. They might reflect their transactions. You know, some companies, they follow their transactions. They, you know, they declare all 100% correctly. But just that they do not follow the right accounting standards, they might fall under this false account as well. So these are all the possibility that might happen, you know, when there is a value traps. All right. So why do these false accounts occur? All right, we talk about, you know, they don't follow, they don't reflect, but why? Why a company doesn't want to reflect or let you know that they are doing good or bad? When we talk about listed company, shouldn't be they are transparent to all the investors, you know, in terms of corporate governance, they should, right? But why some company want to risk, you know, want to take the risk just to let you see that, just want to do this false account? Have you ever wondered why? Okay, now the first reason why, because of tax avoidance or tax evasion. You know, some company, they want to avoid tax, so they do false account. They simply want to make the profit and loss statements, right, looks like we are not earning that much of money. No, they just don't want to let the government or let the LHDN to take a lot of their corporate income tax. So they purposely go and do some hanky-panky thingy onto their accounts. Now, this is one of the things. But this reason or this rationale behind it, right, that motivate most of the small enterprise or small medium companies, because they are small. So they don't think that the you know, the LSDN is going to come after them. So they do that. But lesser that we can see this kind of a tax avoidance or tax evasion happen in listed company. Okay, lesser. Then we wonder, what are the second reason why the listed company wanted to do false accounts, right? So it comes to the second thing. Now, this is a valid reason why they want to do it, because of the credit needs. We all know that all the companies, right, they need money. Going public, you know, going public listed on in the stock exchange is one of the way they can get fundings, right? But the fundings, it might use up in 5 years time, 10 years times. Then they need to raise more money from where? You know, most of the common way, you know, the common way that they will go to the banks, to the financial institutions to lend them some big money. So if let's say the company is not doing well, do you think that they can get a lot of monies, you know, lending from the financial institutions? Lesser chance, right? So what do? They let, you know, they boost up their accounts, they boost up their financial, just to show that now we are strong, you should lend us money. So they showed it just to get funding from the banks. Now, this is one of the reasons most of the companies, they want to do false accounts. You know, bear in mind one thing. As a person, when we go to banks to, to ask for financing, just to buy a house or buy a car, they also look at how much money you earn every month or on yearly basis, right? The same things. If the company is not earning that much, or they already have a huge pile of debts inside the accounts, why do the bank want to lend you more? So in order to overcome that, they need to have more incomes. They need to show that they are strong enough to survive with this huge debt, So these are the reasons why some companies, they want to do false accounts, right? Thirdly, some performance needs, Remember, okay, when a company, they goes public, people, their investor, are looking at their accounts, look at their performance, all right? They will think that, okay, now you're going public, right? Then you should perform better. You should perform better. So in order to perform better in the stock price, what must come? The company financial performance, right? The performance must come so that the stock price will keep going up. So in order to do that, some of the companies, they might, not say they have to, but they might do this kind of things just to show people that, okay, we are strong. That's why you support us. You support us, You support us. You are not wrong. You are smart. Because of you, now our company is doing good. Our company is doing better. Now our stock price should rise. So that's some of the reason why some companies do that. Okay. And fourth, the last point is that project needs. Okay. So to give you some information, right? When there is a construction companies or a developer developers, but most likely is construction companies. When they want to go to bid for some projects, they need to show their accounts. So for example, if let's say one of the construction company is bidding for MRT project in Malaysia, so they need to, during the bidding, right, they need to show that, okay, our company have a good financial position to support us to do this project, because right, infrastructure project in Malaysia, it can easily goes, worth few hundred millions per contract. So for a company to take up this 100 millions project, they need to have a good financial position to show to the government that, okay, my company have the ability to take up this project. Now we are strong. So in order for them to successfully bid the project, they need to show a good accounts or a good financial strength in their companies. So they might do this kind of a thing just to show and to get a project. So here are the four potential reasons why some companies want to do false accounts. Now, remember, these are all the risks. Because whenever you go and do this hanky-panky thingy, one day you will get caught. One day you will get caught, right? So they want to take the risk. These are the reasons why they want to take the risk, right? Now, after we know about the false accounts and the rationale behind why these people want to do this thing, right? Next, we go straight into the points. How do we identify the value traps? Okay, because first, for us to identify the value traps, first we need to understand what it is. Okay, what is a value traps? So remember, I think most of you are a value investor in our webinar today, right? Let me ask you a question. When the market is full of fear, and the stock price crash, do you think it is a better time or better entry point for you to buy into the company that you like? Or you think that this is a value stock that you want to buy? So you go to buy whenever there is a market crash. All right. Let me know your answer. I wanted to know. As a value investor, will you do that when markets is in fear? Let us bring you back to 3 years ago during 2020. COVID-19 hit everyone in the world. Stock market crash. So when the stock market crash, do you think that it is the good time for me to buy into the stock that I like. That I think that this is a value stock and it's fall below the value. Now the price has fall below the value. It is in the undervalue territory now. Should you go into it, right? Most of the value investor, they will tell you, yes, we will go into it because we have a huge margin of safety. The price is below the value now. So it is a good time for us to get into it. But bear in mind, all these crash or all these correction in terms of stock price, it might not have a correlation between the stock price and the value. Now everyone know. And in terms of the timing, right? How do we know that now is a good timing? So when we encounter these kind of situations, we will think that it is a good time. So I enter into it. And then 2 years later, 3 years later, you'll find it, hey, why is this stock, the price still remain the same as in 3 years after the crash? Then you will think that, oh, I'm in a value trap now. So don't get carried by your emotion. Whenever you think it is a good time, think twice. All right, think twice. Okay, now, if a company is healthy, right, it's rather cheap. So this is as what I mentioned just now. I think I already mentioned about it. But we need to ask ourselves 2 questions. Is this a temporary setback or is there a financial problem for the company? Now we ask about this. So for example, in 3 years ago, in COVID-19 times, we all know that it is not about the company financial, but it is about the entire economy, the macro economy that caused the market stock price to crash. And second thing, would it damage the company future prospect? The answer is yes, right? In terms of COVID-19, just think about COVID-19. All the businesses have to close down, lock down, economy cannot run. So this will damage the company future prospect. So when we ask these 2 questions, then you will know, is this a rather cheap situation for the stock price for me to get in now? Or is it just in an emotional, because of the sentiments, so that the price crash, but the company fundamental is still strong, So these are the questions when we are identifying the traps, we need to ask ourselves, because the traps often occur, or when will we fall into a trap is when we are emotionally high. We think that we are right all the time. So we think that, okay, this situation, it is a very bargain sales. Why not I enter now? So you will just enter into the market without asking some question or without looking into it clearer, And these traps are always contain some wrong ratios, such as price earning ratios, price to sales ratios, and price to cash flow ratios. Now, I know most of the value investor, we all love to look at PE ratio when we pick the stocks, right? The lower the PE ratio, the more undervalued the company is. Some of the people, they always talk about this, right? The lowest the PE, then the value is better. People always talk about it, but it is true, because often the value traps come to the PE ratios. Yes, it is, right? Now, let me use the fundamental to guide everyone to avoid the value trap. Is that okay? Now, when we talk about the fundamentals analysis, there are 3 statements that we often look at, right? One is the balance sheets. One is the statement of profit or loss, or we call it P&L statement. And thirdly is the cash flow statement to show the actual cash flow of the company. Now, balance sheet. First thing, we look into the balance sheet. So these are the criteria, when a company is looking quite undervalued. Okay. So I just show everything first, then I will explain, right? So first thing, the company has a very high profit after tax, or we can say the company is a profit-making company and the profits is increasing, is increasing. And then for value investor like us, we won't look at profit itself. So what will we do? We will look at the cash flow to see whether the profits is certain, right? Then we look at the cash flow. Oh, this company is making a positive cash flow. Their cash inflow is good, you know, and their revenue is continue to grow. They are in a very good business. You see, their orders are coming in, their bills are coming in, their revenues are growing. They have a higher profit after tax. Their cash flow is good, is healthy. Everything is positive. Okay, if everything is positive, but the liability is also increasing. Now, I know some of you might already have some, you know, some of companies the name started to blink, you know, in front of you. Yeah, that's correct. Because most of the value traps, they all look the same. Okay, they all look the same. Now, whenever you see a company's, you know, the profit, the revenue, the cash flow are all very good, healthy, but their liability is also increasing. And the management will tell you, oh, we need money to grow. You know, in terms of for us to achieve, you know, double-digit growth, we need more money, you know. So we need to borrow more. And that's where their liability will increase, you know. And you will see, you know, you will often see this kind of situation in their accounts or in their statements before these investment run into a value traps. Okay, before it. So bear in mind, these are the symptoms or these are the criteria that we can go and look out for a red flags, you know, whenever we do value investing. Second thing, all right, we analyze two balance sheets indicators. So I will show you some of the formula how to calculate on the ratios, and then why. Okay, I'll show you why later, right? First indicator is debt to equity ratio. So the simple calculation is you take the total debt divided by the total shareholders' equities to see if the company has too much debt, or we say their gearing is high or low, right? It is always ideal if a company keep a low gearing ratio. Okay, preferably less than 0.5, or which is 50%. This is a common rule of thumbs, you know, people always use it, right? But when you see some of the company, they are in a higher gearing, you know, their gearing might be, you know, 1 times of their equity, 2 times of their equities, and you can see, oh, this something might happen, right? Something might happen. Yes, and then okay, let me just give you more ideas, right? When we talk about gearing ratio, we also need to understand what industry the companies is in. Okay, because some industry they might not need huge cash, you know, or debt to run their business, or we say capex, you know, they might not need a lot of capex to run the business. So typically this type of the companies in the industry, right, their gearing is lower. But if let's say all their peers having a lower gearing, but this particular company, the gearing is slightly higher, or we can say it's much higher than others of the, you know, of his peers, then it is a red flag, you know, it is a red flag for us to take care of it, right? So first thing, look at the debt to equity ratio. Second thing, look at the current ratio. Okay, current ratio is the current asset divided by the current liabilities. Because when the company have some problems, oftentimes you can see their short-term assets, you know, are running low. You know, they might not have a lot of current assets or liquidity assets, you know, or liquidate and to pay off their short-term liabilities or short-term debts, you know. So we often look at current ratio. If the ratio is high, it is good because the company has more liquidity, you know, to handle these issues. All right. So these are the two ratios in terms of in the balance sheet that we need to look at it. Okay. so far so good, right? So far so good. These two ratio, I think everyone is okay with it, because in value investing, these are the ratios that we look at, right? Then we go into the profit and loss statement and also the cash flow statement, right? Because after we look at the balance sheet, we need to know, or we need to analyze and verify whether the earnings, the profit are good, or they are the genuine one, So always bear in mind, the surplus does not necessarily means the actual profit the company earns, right? I think some of you might know, some of you might not know. Okay, we often go to look into the cash flow statement to double confirm, whether this company is actual earning, or this is all in the orders, because of the accounting standards, right? Some of the orders can be recognized as revenue. Some of the orders cannot, right? These are all according to the accounting standards. So we also have to look at the cash flow statement to verify, the company's profit, it is actual profit, or it is just in the receivables, which the company does not receive any cash yet for the orders, right? So these are the places that we often look at, to avoid falling into the value traps. Now, after I've talking so much, right, I wanted to go into a real life example or a real case, to show everyone how can a company, a very good prospect company during that time, but it is still a value trap to the investors. All right. Now, let me show you the example, right? So the name of the company is Megan Media Holding Berhad. How many of you heard of this company before? Okay. Or how many of you has invested in this company before? I think not much, because this company is an old company, and is now delisted in Malaysia. So yeah. So I don't think you have you once invested into this company before. But today I wanted to use this company to show a case to you all how value traps looks like, in terms of the numbers, in terms of the share price, right? Now, because I know most of the people never heard of this company before, or don't know about this company. So let me just do a company background and some history for you all, right? To introduce you to this company, Megan Media Holding Berhad. So this company was founded in early 1994, and they started by doing plastic injection components and some electronics and automotive components. Now you might wonder how all these components look like. So I give you some example. So these are the things that they produced, during the time they first founded, in 1994. Okay. Now, so in 1996, this company, Megan Media, I would just say MMHB in short, right? They recognized the trend in the data storage media. So back in 1990s, videotapes, cassettes, these are all hot things, not like in this moment, what we use, SSD, people might not even use hard disks anymore, right? We use cloud storage. But during that time, in the 1990s, the videotape, the cassettes, they are the stars for the data storage. So MMHB, they recognize this trend very fast. So they started to use their subsidiary companies to manufacture, multifunctional discs and videotapes. Okay, for those who never know what is the videotape, you can look at the pictures. Okay, on the right side, that one is a videotape. Okay, but obviously that one has been dismantled, so you don't see the real one. Okay, but that one is the videotapes, right? So in 1996, this company started doing it. Now, when they started doing it, people think that, wow, you are in a very hot market. This is the trend. Just like when people started to go into the internet, in the 21st centuries, in the 2000s and above, right? So in 1999, this company, through the subsidiary, expanded and entered into the manufacturing of CD and DVD. Now, these are all the things that I used, during my younger time, So DVD and CD. So this one, last time, it is a good storage media, for us to store music, to store movies or videos, in DVD or in CD. So these are the, what we say, the babies. Everyone wanted to buy it, that time. So Megan Media Holding companies, they started to recognize these trends and they started to manufacture it. And they became the first Malaysian company to receive the pioneer status, for manufacturing these kind of disk and data storage products. So then they got listed in KLSE, which is now we call Bursa Malaysia, and 2 years later, they successfully transferred from the S market to the main board, So it's kind of fast for a company as because they are in a very good industry, they're in a good trend, so their products are sought after at that time, and because also due to their aggressive marketing strategies. So they have become the largest manufacturer of CD and DVD in Malaysia at that time, in 2000 to 2002. They have become the largest manufacturer of CD and DVD in Malaysia. Now, when you heard about this company, after I shared about the company background and the history, do you think that you will buy into this kind of company during that time? If let's say you are the investor, will you buy into it? Because the prospects just sound promising, The company is in the ever-growing industry, and they are the largest manufacturer. Why you want to invest in other companies when this is the pioneer and this is the leader in the industry, right? So this is one of the reasons people fall into the value trap for this, right? Yes, I can see some comments here, right? That time a lot of people taken in by it. Yes, it is, because this story just sounds promising, Just put it into current time. Any story that talk about AI, you will buy into it. Am I right? This is the same back in year 2000. So now, in the year 2000, if you are picking a stock based on the PE ratio, you will never miss Megan. You will never miss it. Because why? When it first got listed in year 2000, the IPO price is 2 ringgit 50 cents, per share. And on the first day, it went up to 4 ringgit 50 cents. Wow. And the lowest is 3 ringgit 90 cents. It means in the first day of the listing, you can earn close to 100%. If let's say you set it at the highest. This is the price. Remember that 2 ringgit 50 cents is the price when it first got listed. All right. Then we look at the earning per share before we go into the PE, right? Before we go into the PE. Now, let us look at the financial year 2005 and financial year 2006. Later I will show you a comparison during the year that they go IPO. All right. So as you can see, the profit after tax for this company in year 2005 is 65 million. It's 65 million. And in 2006, it is 60 million. And you can see they have slightly increased the ordinary shares during the year, and therefore the earning per share is lower. Okay, therefore the earning of share per share is get lower. But even with the earning per share, dropping from 34 cents to 39 cents, the PE ratio of this company is also dropping. You see. So when it first got listed, right, the PE ratio is at 20 times. Is measured at 20 times. How do we get that, right? We use the average price of 4 ringgit 50 cents plus the 390, the lowest, divided by 2. We just use the average price. If let's say you buy into Megan Holding, during the first day of the IPO, with the earning per share of 21 cents at that time, your PE ratio is 20 times. And 5 years later, the PE is 3.5 times. Do you think that you will buy into this company if, let's say, you merely pick a stock based on PE ratio? You will think that this is a value buy. The company PE just dropped from 20 times to 3.5 times. And it is in a very promising industry. It's had a very good prospect. Now people will buy into it, right? And many investors did bought into the idea of this PE ratio getting lower. They will think that this management is very good. No, they are adjusting their PE ratios just to let us, have the chance to buy it, have the chance to invest into it. So people think this is a good time. And in year 2006, the share price dropped even further to 79 cents only, per share. And the PE is 2.6 times at that time. So if let's say you are a new investor during year 2005 to 2006, you think that, wow, I wanted to do some value investing, then you will buy into this company, the Mega Media Holding Berhad, right? But let me just show you the share price. Let me just show you the share price. If let's say we look at the historical pricing, you can see the price of this Mega Holding start to drop, in 2005. Okay, and before 2005, it actually started in 2004. From the highest of 2 ringgit something, dropped to below 1 ringgit. So it is because of the stock price, issues, so that the PE ratio is lower. But for whale investor, for some reason, they don't really believe in the stock chart, so they don't look at it, right? So some people don't look at it, so they will miss it. They will miss it, right? Now let me just take back what I shared just now, bring you back to the criteria that I showed you just now, how to identify the traps, right? And we see whether the Mega Media Holdings company Berhad is, fulfilling the criteria. So first thing, we say the company profit after tax must be high, right? So in year 2005, the company is earning 65 million profit after tax. Is it high? What do you think? Is it high? And the cash is still in positive, the cash flow is still in positive, right? In year 2005. And in year 2006, you can see, wow, the company have a cash and cash equivalent of 53 million. That's just insane. They nearly, twofold the cash flow, the cash and cash equivalent just in 1 year, in 2005 to 2006. And in terms of revenue, it has a continuous growth. You can see from 900 million something to 1. Wow. This company is just, ticking all the criteria. Tick, tick, tick. And yeah, it is a very good company. You see? So we just do some differences here, not to let you know that you are not good in mathematics, just to show you that the companies is doing it, right? So you can see the revenue for the differences in terms of revenue. The company is adding 130 millions in 1 year, in the revenue. And trade and other receivables also increased by 261 millions. Wow. Okay. So from here we can see, right, the trade receivable over revenue is getting higher. Now this is one of the red flags we can already see, right? When your revenue is increasing, it's growing, but it's growing and it is all in the receivable side. No, it is all in the receivable side. That means you haven't received the cash for these orders or this revenue. It's not your hard cash yet. So this is one of the red flags that's shown during that time. But most of the people, they don't know it, right? So let us look at the borrowing. Just now I mentioned, right, when you see all this promising kind of thing, right, we look at the borrowing. And yes, indeed, you can see the borrowing is increasing from 646 million to 838 million at the time. All right. And the borrowing over equities ratio, which means the gearing ratio, is at 1.78 times. It's huge, The gearing ratio, the company is highly in debt. And this show a very, very important red flags for all the investors during the time. All right. And then we want to deep down into it, right? We want to dig more of this company, whether we are wrongly examine this company as a value trap or whether the company is actually in the value trap. So we need to do more. So in the second ratio or indicators, right, reduce the current ratio. So we take the current asset divided by the current liabilities. As you can see, the current ratio is high. It's 2 times. It shows that this company has no short-term issues, you know, in terms of their current ratio. Just based on the ratio, right? But is this true? Is it true? So let us look into their balance sheet. Okay, as you can see, in the current assets, right, their trade receivables is increasing hugely, you know, from 298 million to 562 million, just as what I mentioned just now, right? And their current liability is getting lesser, you know, from 55 million to 39 million. And this caused the current ratio look so nice, you know, 2 times. It's just very good, you know, but this is because of the trade receivable. If we take out the trade receivables, we just look at the cash and also the borrowings, then you will know the current ratios doesn't look that good. Okay, if let's say we dig down, we go deeper into the company's finances, right? And then we go and look into the trade receivables. You can see, you know, the trade receivables is higher, and even higher is the other receivables, you know. So what is the other receivables? The other receivables is the deposit, you know, deposit of a 211 million paid for a purchase of plant and machineries. Wow, it is a deposit, you know. So if we take out both of these trade receivable and other receivable, the company have, you know, a very little current assets during that time. So when all this happen, then we all know that this company is in a value trap. Now, is that okay for you to, you know, for you to take it after I have shared all these financial statements and the ratios and how we identified it? Do you get what I want to share with you, you know, just based on this historical event that happened? And you know what? This Megan Media Holdings, and if let's say you go and Google search it, right? There's been the chairman of the executive chairman of this company has been charged, you know, by Security Commission for their false information filing. You know, they did provide some false information just to make their companies look promising during that time. And the executive chairman has been charged and found guilty, and the penalty was 18 months jail time and some fair amount of fine, you know, by Bursa. So you can go and Google search of it, and I believe the articles or the analysis is still in Security Commission's website, just to let all the listed companies management knows and all the investor knows that we will not, you know, we will not tolerate onto this kind of false doing. You know, these are a huge huge issue for a listed company, you know. So they punish the executive chairman hard on this issue. Now, this is just one of the case. And if you go into Google, you know, or if you go into Security Commissions, you will find more of this kind of issue back in the day, right? And then some companies, some issue happens during past few years, you know. Names I don't mention, right? Just now some of you have already mentioned about the names, you know. We don't, you know, we don't assume whether they are in false accounts or not, right? But definitely you are already in the value traps. Okay, and bear with me, and I want to correct my saying. False account and value traps are 2 different things, because false account is a crime, but value traps is a trap that some value investor might fall into it, you know. So be careful whenever you say this company is doing false account or you are in a value traps. Okay, these are 2 different things. So okay, so let me just summarize what we learned from Megan Media Holding Berhad just now, and also what we have learned from my session just now onto how we can identify the traps, is that when the company has a good revenue and their revenue is growing, and the company has a good surplus or have a good profit after tax, and their cash flow is doing just fine, or they have a very healthy cash flow, but their issue lies in the liability side. Okay, but you can see this kind of company with a huge liability, okay, and some of the ratios, they manage to make it just happen that these ratios are just good, just nice for a value investor to invest in, right? So one last thing I want to share, don't always rely on the ratios. We need to always, do a further due diligence into their statements. Just like what I showed just now, we dig down into the receivable side, right? These are all the things that people might not know, because you just look at the ratios and you think this company is so nice. This is a value, this is a gems. Wow, I just found a gems, to invest in. But if let's say you go deeper, you go into the research of the financial statements and you found out that, oh, all these ratios are made up, by the companies just to show you they are in a very good position, but they are not, right? So we always have to do a better research, or a thorough research onto the company whenever we are doing the value investing. All right. So these are the ways to identify the value traps. Now, last, before I end my sessions here in today's sharing, if you are already in the value traps, how can we avoid it, or how can we survive from it, right? Some people, what they do, or not some people, most of the investor, when they are already in the value traps, what they do is that they will buy more because they want to average down their pricing. Now, how many of you, just be honest with yourself and with me. If you are in this situation, will you average down your price, or will you average down your cost, just to make your portfolio looks like you are not suffering much, or you are not suffering huge on this, right? Okay, some people say cut loss. Yes, cut loss is the answer. Cut loss is the method for you to survive on this situation if let's say you are in the value traps, right? But most of the people, they don't want to cut loss because this is their hard-earned money, and they have one mindset, if I cut loss, these losses are now realized loss. Because if let's say they are still sitting in your paper, they are considered unrealized loss. I'm not feeling the losses yet because I haven't cut loss. But if you cut loss, this money is the real money that you have already lost it, right? But, but the truth is often hard to be taken in. So remember, if you want to survive from these value traps, all you need to do is cut loss, all right? Because the company has no fundamental anymore. The fundamental is not there anymore. Then we classify it as a value trap. And if the company has the fundamental is still strong, still ongoing, then you don't classify this investment as a value trap. Just there are some adjustment on the pricing. All right. So these are my sharing on the value traps and how to identify and to avoid it in whenever you are doing value investing. All right. So thank you very much, everyone. And I pass it back to our moderator today for some Q&A.
Thank you so much, George, for doing us this topic, which is how do we avoid value traps in value investing. So if you have any question to ask our speaker today, you may write them in the Q&A box. We will address them accordingly. All right. I think, Josh, just now you mentioned about false accounts, criminal offense is an criminal offense, right? Now,
yes.
Won't the regulators like SC, Securities Commission, or Bursa Malaysia investigate and penalize all these
Yes.
companies?
Yes, Security Commission and Bursa Malaysia, definitely they will identify into all this kind of company, right? Whenever there is a false account. But bear in mind, all the accounts of the listed company, they have their auditors, right? They have a strong auditors to audit their accounts. So if let's say, you know, when the auditor say this account is an unqualified account, that means this account are good, okay? Then it won't trigger Bursa Malaysia or Security Commissions, you know. So you say, will the regulator go and look into it? They will. But because of the auditor saying that this company are good, then maybe this kind of company, they get slipped off the eyes of the regulator. So it might happen, you know, it might happen. And sometimes it always happens until we finally found out the crime that the company is doing, right? So as an investor, I strongly encourage every one of you, you know, always look into the company's accounts, and whenever you have question about their, you know, their numbers, raise it up during the AGM, you know, because as a minor shareholder, we have the right, now we always have the right to question the management, you know, on their prospect, you know, on their accounts, or on their management of their debts, you know, how they manage their debts and everything. We are the shareholder, we have the right. So you can always raise it up. And if let's say you found that this issue is big and the author and the regulator does not take any action of it, right? You can actually report it to, I think we have a group that taking care of our minor shareholder. It's called MSWG. You can also raise your complaint to them, you know, and they will further help us to investigate onto it. So I think these are this is the answer I can answer back to the question just now.
All right, thank you so much, George. The next question is by Alex. How about companies who keep increasing their company free float shares or any other form of preference share and therefore lowering their price to earnings ratio to keep the share price low? So what do you think?
All right. So just my opinion and based on my past experience in value investing, right? When the company, they wanted to lower their PE ratio, okay, this is one of the red flag that I see. Because why does a company want to lower their PE ratio? Instead of focusing on, you know, managing their companies, you know, getting more sales and everything to make your earning per share higher, or to make your company earn more money. But instead you do some corporate actions just to bring down your, you know, your PE ratio. But this is just the assumption, because the company won't let you know, right? The management won't tell you that, okay, why we do that is because we want to lower our PE ratio. They won't tell you that, right? So some of the ESS or VSS or the share buyback, right, it's actually good because the company have their own, you know, planning of the shares. So we cannot say that all these things are not good, or sometimes we look at the ESOS, right? Some people will have two different opinion on companies that do ESS, ESOS, you know, VSS or share buyback. But all these are actually based on the companies or the management planning. And if the planning sound legit to you, then it is considered okay. But if you as a shareholder, you also cannot buy into the idea of the management, then it might trigger your red flag and why you want to continue invest in this kind of company. So go back to Alex. I think you should always think twice, you know, when you face this kind of situations.
Thank you, George. The next question is by Joe Mark. What is your top criteria in financials that you always look for in investing? Something which the company cannot manipulate, or it is less manipulative.
Okay, good question by Joel. The things that I always look into it, right? If let's say you give me 10 minutes or 15 minutes to, you know, briefly go through a company financial statements, I always go to the cash flow statement instead of the balance sheet or the profit and loss statement. The first statement that I will go straight into the cash flow statement, because I wanted to know whether this company is making positive inflow or positive cash flow in their operating cash flow. This is the first thing. So after we look at the operating cash flow, and don't look at only 1 year, always look for past few years, 5 years or up to 10 years if you can get the information, and then you compare it with their profit after tax or their earnings. From there, you will find a balance, or you can find the trend whether the company's accounts is genuine or they are making real money from the cash flow. So these are the things that are less manipulative in terms of a cash flow, but obviously you have to always look into the items as well. But if let's say you give me 10 minutes, yes, the one thing I will go is the cash flow statements.
All right. So you think cash flow is more important than some other statements in identifying whether this is genuine business or they have the tendency to manipulate their income statement.
Yes.
All right. The next question is by Sam Nair. Many companies use their creditors to fund the business activities, and this can increase their liabilities. What is the view of this?
Okay. Now, just now, I think in my sessions, I did mention about the industry as well. Some industry, they need higher capex, to run their business. So they need to lend more money, right? But we always think twice in this situation. If a company, let me just ask you all a question. If a company have to always raise money or raise fund just to operate, or continue their business operation, do you think that this is a good company? Or once they raise the money and they go into the market, they put into their manufacturing or they put into their productions and they earn profit from there, do you think that this company have to always go for funding, just to sustain their business or to grow their business? Why they cannot use their profit that they earn, to reinvest into the company and to run the business? So these are the situations when you see whenever a company, they have a new projects or they have a new orders coming in, but they always need to get funding. Whether they are going from private placement, from raising the right issues, or from the financial institution they borrow from the financing. All these are the ways that they can raise fund, right? But why? We always have to think why this company have to always look for funding. If they are making huge money, their profit is growing, their revenue is growing, they should have enough money, to fund their business instead of always look for funding. So this is the answer I have for Sam Nair. So yeah, but by all means, the company can still go for funding if this is under their their planning, their management. They don't want to use their own cash, then it's okay. This is the management decision to make, right? But as an investor, I will question why. So that's the answer to Sam.
All right, thank you so much, George. So the next question is by Amir. How early could we discover a value trap? Like, for example, let's talk about Serba Dynamic. Is this a value trap, and will it be alerted much earlier?
All right. So yeah, since everyone have talked about Serba Dynamic, right? And it is a value trap, or how can we alert it earlier, right? If you look into the financial statement of Serba Dynamic, even before the scandals, or we can say the stock crisis of this company, right? You can always find that the company's liability is high. Even not only Serba Dynamic, if you look into some of the related companies in the market, right? You can see the business are growing, but their liabilities or their debts also increasing tremendously. So during that times, even the share price is growing, that means the PE ratio is not in the very nice area at the moment. But I can always say this company has some issue going on, because you cannot always sustain beef debts. when something like COVID-19 hits, when the business is not doing good, you can't generate more cash flow to repay your debts, then you might have issues. So during early years of Serba Dynamic, just to make a clarification or a disclaimer, I never invest in Serba Dynamic before because of this issue. I look at their huge debt piles during that time, and some of the corporate actions that they do just to raise funds to fund their business. I find that this is considered a red flag for me. So yeah, so I never invest into Serba Dynamic, and yet so many people get trapped into it just because they think that this business is doing good, you know, at that time. So yeah, you can identify just based on the criteria that I showed just now. Then you will know the company is actually likely into a value trap, you know, just when it will trigger. Yeah.
Thank you, George. The next question is regarding your view on this company, Insas. I think Insas has been fetching a very low PE ratio. So what do you think of it? Is it a value trap?
Okay, so first of all, I don't have interest into Insas, so I actually don't really research onto it. But based on my understanding on Insas is that it has been, the price or the PE ratio has been hovering at that level for many years, you know, because I think most of the people know that Insas have a very good subsidiary company which is also listed, right? And then just that their shares price is not moving. For me, this kind of company, I have no interest in it. So yeah, so if you ask me this is a value trap or not, so sorry, I cannot answer you just based on my understanding now. Yeah, I think maybe you can, based on the criteria that I shared just now, do your own research and you know, and you let me know whether is this a value trap or not. Right.
Right. So the next question is asked by Ui. What about ARBB? The PE is also pretty low.
Okay, right. ARBB, so sorry, I never. Okay, if let's say Insas and ARBB, Insas, I still know about their business, but ARBB, so sorry, I never looked into this company before. So I can't say much on this. So sorry for that.
All right, but anything that, just want to reiterate that anything that the speaker has said shall not be construed as an investment advice. That is purely the speaker's view only, okay?
Right.
The next question is by William. Now, some companies give high dividend yields to attract investors, but the share price is not good. Is it a value trap? Should we avoid it?
Yes, very good question by William. For me, I don't classify this as a value trap, but this is a dividend trap. Okay, to be specific, this is a dividend trap because this happened and it's still happening in Malaysia stock market. You can see a lot of companies, right? If let's say you just do a research on dividend yields, you can find a lot of good company paying a high dividend yield up to 6%, 7%, even 8%. But if you look into their share price, you can notice that their share price is dropping year after years. So this for me is a dividend trap, because whenever you buy into this company, right? Okay, so first of all, why do you want to invest into a dividend company? Because you want to earn from the dividend incomes. But if the dividend income cannot, you know, or has been offsetted by the losses of the share price, then you actually earn nothing, you know, or you might even in the losses just because of that. So this for me is a dividend trap, and you should avoid it, right? You should avoid it. So how do we actually identify that, right? Is basically you just look into the past few years stock price performance, and also look into the real dividend paid out, okay, per share. Okay, look at the dividend per share instead of the dividend yield. Then if let's say you are looking at the decreasing dividend per share, then you might know that this company is not actually generate a lot of income in the past few years. Their dividend might not sustain for, you know, for the next 5 years to 10 years. Yeah.
Thank you so much, George. Now, the next question is by Wing On. Now, Transmile was once a favorable stocks for fund managers until the accounting scandal came out. So why the fund managers are unable to identify the red flag of this company?
All right. Transmile, yes, one of the biggest scandal back in the time as well. Why the fund managers are unable to identify, right? Because you have to understand, fund managers, their role is actually to invest, to find a good company to invest. So when they look into the companies, right, they not only look into the numbers, they always look into their prospect. And if let's say the company is in good prospect, just like Megan, right? Just now when I talk about Megan, people say, yes, people during that time, they buy into the companies because of the promising industry outlook, So some fund managers, they have to follow the trends. And you see, fund managers, their KPI is to invest into companies because they have a lot of cash investment into them. So they need to invest their money somewhere else. They cannot just let the money sitting in the banks earning 0% interest. So they have to find somewhere. So these are the KPI, or we can say the pressure that they have to invest into companies. And some reason, for some reasons, fund managers, they also look into the ratios. But I'm not saying that they not look into the details, but some they might look into the ratios, and that might cause them invest into some accounting scandals. But nonetheless, if the company is very good in doing the creative accounting, then fund managers have no ways to find out that is the false accounts. So there are a few reasons that why fund manager cannot identify it. But for Transmile, I think is that the accountants or the auditor of the company is just very good.
All right. Now, Josh, just now you mentioned about dividend trap, and we have a follow-up question from Amir who asks, would you agree that Tenaga Nasional Berhad is a dividend trap?
Okay, good question. I don't think Tenaga Nasional is a dividend trap, but there is others company in Malaysia that might, if let's say you are investing for since a few years ago, you might already in the dividend traps, which some like they have a huge dividend yield. For Tenaga Nasional, one thing is their fundamental is still there because they are still the only Tenaga operator in Malaysia, appointed by the government. So their status of their monopoly status is still there. So yeah, so for me, Tenaga is their fundamental is still there. Just that you still need to look into their dividends. Because to be honest, I never invest into Tenaga Nasional. Yeah. So for me, their dividend yields and everything just not my things, not my vegetable. Yeah.
Okay, not your vegetable. All right. All right. Alex would like to ask, do you have any comment on those companies with high volume, yet they are selling at a very cheap price, like AT, LKL, BC Mall, just to name a few examples?
Okay, Alex, high volume and a cheap price, I don't see a correlation here because high volume just simply means that many people are actually trading in it or transacting the shares, right? Cheaper price might be one of the reasons people are transacting the shares because it's cheaper. It's, you need a very low cost to buy into their share. For example, if let's say you look at the shares, the sum of the stocks, right? They have a share price of more than 10 ringgit Malaysia. You can see their volume is low, just simply because their share price is high. The cost of entry is higher. So for me, I have no comment for this. I won't say the company is bad, just based on the volume or the cheap price. I would say, yeah, people are like different people. They have their own methods to invest into shares, but all these kind of cheap price and high volume, they might not suit our value investors. Yeah.
All right. The next question is by Lim. So which quantitative criteria is the most important for us to evaluate in order to avoid the value traps?
All right. So if let's say you're asking me only one, the most important one I would say is the management credibility. Okay. So these are quantitative measure because the credibility of the management, there's no numbers, for us to qualify whether this management is good or bad. right? So how can we measure the credibility is by the actions of their executive chairman, of their CEOs, or their managing directors, or from their AGMs. Whenever you go to AGMs, you can raise questions, right? You ask for their prospect, and then you can always see whether the company is actually going, as the CEOs or as the managing director says. If let's say they always give you a very big picture of the directions that they are going, but they are nowhere near the goals, right? Then you can see this management maybe, their action plan is not there. So this is the most important criteria that I will look into it whenever I invest into a company for the quantitative one, right?
I think what you mean is the qualitative. Yeah.
Oh yeah. Oh,
that's
sorry,
right.
sorry,
So
sorry,
the question is about quantitative.
So sorry.
But we appreciate that. We appreciate your response on the
Okay.
qualitative.
So I'll come back to the question. So sorry about it. Quantitative and qualitative. Yeah. So for quantitative, right? Yes, just the number, right? The most important, I think I have answered this one just now, right? The cash flow statement. I will look into the cash flow, and yeah, from there you can always
any ratio, like how many percent of the operation cash flow against the revenue or the net profit before tax.
I don't look into the ratios much because I think ratio is easily manipulated.
All right. Okay, the next question is by Wing On. If a company announces a one-off special dividend with a very attractive yield, is it a value trap if we purchase the stock after the announcement of the special dividend?
Okay. To answer Wing On, right? Do you know that if let's say the company declare a dividend and they pay out the dividend after the exit, right? After the payout date, right? The share price will adjust based on the dividend. So it is a value trap if let's say you are buying into the company just based on the special dividend, after they have announced it, because the share price will adjust, the share price will adjust. So you just, for example, you invest 1 ringgit into this company and they are declaring a 50 cents a special dividend. Let's say after 5 days, you receive the dividends of 50 cents. And the share price will now adjusted to 50 cents. So you're actually at your cost, at par. So I don't see, is this a very attractive way for you to invest into the company? But is this a value trap? It might be if let's say you are investing into this company simply because of the dividend, then you might be in the trap because of that. So you have to know the adjustment of the price after the dividend. Yeah.
All right. So do you see Astro? How do you see Astro? Do you think it's the value trap?
Okay. If let's say you ask me about Astro, is it a value trap? If let's say you ask me in 3 years ago, I would say yes. But now I would say I might change my mind because I started to see some changes in Astro in the way they do their business. They started to focus more on some digital e-commerce kind of thing. So I think the fundamental is changing, according to the industry or to the current market as well. So for me, they might not be in a value trap at this moment. But if let's say you invested into this company 3 years ago, then yeah, they might be a value trap for you.
How about British American Tobacco?
Okay, British American Tobacco is the same thing, and it is a dividend trap. If let's say you ask me, you can always look into the dividend yield or the dividend per share that they are declaring and the share price as well. BAT, for some reason, I think their business has already been in the bottleneck. So I don't think it's a good investment if let's say you are looking for a dividend income.
All right. The next question is by Sean. What is your thoughts of investing in unprofitable growth stocks? Do you see that as a trap?
Okay. So unprofitable growth stock, it most likely happened in US, just as the example that Sean gave me, right? It most likely happened in US is because they allowed them to get listed, but in Malaysia they are not allowed to get listed if let's say they are not profitable, right? So for me, investing in unprofitable growth stock, right? People often look at the price to sales ratio, you know, because they don't have profit. So they look at price to sales ratio and they will invest into this company. But for some reason, all these growth stock, they are technology stocks, you know, and technology stock, they are very uncertain in terms of their research and developments and in terms of their competitions, you know, in the market. So for me, I did invested in some of the unprofitable growth stock in US before, but for at this current market, you know, and this current economy, right, I would say not a good choice for you to invest into unprofitable growth stock unless they have shown a good action plans to lower down their losses every year, and you can see they are moving into profitable territory. Then yes, you can start to invest in this kind of company. But often say this growth stock, they are mostly highly valued, so I don't think they are undervalued for value investing point of view. Yeah.
I think you may need to have the strategies and the mindset of like a VC, venture capitalist, when you want to approach all these growth stock, but they are unprofitable because they are still fighting for market share. They are engaged in price war in hope to get more market share. So so if you have a sophisticated investor and you have the experience and strategies on how to go about doing this, you have a longer investment time horizon, then maybe you can go towards this area, because I would think that it is also fairly risky for retail investors. Yep. So the next question is by Ryan. What do you think about Inari? Is it a suitable counter for long-term investment? Now, of course, we know that Inari share price have come down quite a bit. So what is your view?
Yes. All right. So for Inari, I would say it is a suitable stock, okay, given the share price at this moment, right? We always think that technology in Malaysia, we are considered quite okay in terms of our semiconductor industry. And Inari is one of the few good companies in Malaysia, tech companies with a good fundamental. So I think Inari is good. Just that you have to always think about in terms of technology companies in Malaysia, right? We are not in the first tier, and we are actually in the lower end, right? So this is the risk for the companies, and always look at their customers. I think for Inari, one of the biggest uncertainties is their customer base, you know. So whenever their bigger customer have some sales issues, you know, this might cause the performance of the company and the share price to drop. So yeah, for me, I think it is a good company to look into it and to observe. Yeah.
Yeah, I think not many people are aware that, you know, semiconductor is a cyclical industry. Until we reach this period of inventory adjustment, then suddenly everybody realized that, oh, you know, semiconductor is, you know, could be a cyclical industry where they also go through the economy, the supply demand dynamic and the boom and bust cycle. So maybe it could be, you know, during this down cycle, it would be a you know, value buy. So it all depends on your view, right? So of course, whatever the speaker said here, giving his opinion is not supposed to be construed as an investment advice. All right. So with that, we would like to conclude our question and answer session. All right. So thank you so much, George, for sharing with us, you know, how do we avoid value traps in value investing. So ladies and gentlemen, you just heard from the founder and director of EE Cameron, Mr. George Poh.
Thank you. Thank you, Shen, and thank you everyone for spending your time here with us today. Thank you very much.